Welcome everybody to the first episode of Outperforming Opinions. I am Taurus. I'm really excited to get this segment going. Before we get into it, I'm just going to break down kind of what you guys should expect from these kind of moving forward. So basically, in under 30 minutes, what I'm going to do every week is I'm just going to post a video on a company of intrigue for the long term, whether negative, positive, or you guys just want me to do it. We'll make a video and then I'll post it. And the goal is to kind of do a very quick deep dive into the company, looking at their leadership, their price action on their stock, everything, their fundamentals, their financials, and kind of just giving you guys my opinion on where I think they could really go as a business long term. So I'm really excited to do this. It's something that I've been wanting to do for a while, but without further ado, let's get right into it. The first one we're going to be covering in the very first episode, thanks to the Twitter voting, is STEM Incorporated. So STEM came public via a SPAC, Star Peak, STPK was the ticker, and it was one of the ones that I was in love with, and you'll hear about it and a little reason why later. But essentially, let's just start with some quick background. So essentially what STEM does, and you'll see this throughout the presentation that we're about to go through, but if I were to break it down very quickly, what STEM does is essentially they are an AI-driven energy storage company. They're actually the first pure play company of their exact style to go public in the US. So very, very unique company. And as you'll see while we click through these slides and kind of debrief, they have a lot going for them, and they're a very, very strong company in terms of potential. So kind of essentially what we're going to start with is we're just going to look at the leadership here. So there's three main people I want to focus on. Obviously, all of these people are important, but in order to keep it quick and stuff, let's just look at the top three here. I like to pick these three because I think they have probably the most influence over what's actually going to happen with the company. So we've got the CEO and director, John Carrington, the CFO, Bill Bush, and the CTO, Lars Johnson, which that's 10 out of 10 name right there. Lars, I love that. So right off the bat, Carrington, did a little bit of research on him, and he was an executive vice president at First Solar previously, and he also spent 16 years at General Electric, that's GE, as their chief marketing officer. So he does have, quite a bit of industry background with those solar companies, and then as well as being the CEO and director of STEM, essentially since their inception. He's been with them since December of 2013. So you love to see that experience and that lasting staying power, especially in a position like the CEO. That's definitely very encouraging. The second person, Bill Bush, is the CFO. First thing that jumped out to me when I was researching him was just the sheer experience that he has as a CFO. He's been a CFO at 2 previous solar companies, and I believe 4 previous total companies if you're not being industry specific. But I really like that he's been a CFO for 2 previous solar companies. Those are Borrego Solar and Solar Semiconductor. So the reason why I like that is because each industry has its own specific financial niches and intricacies. So to have a CFO that has industry-specific experience, to me, really stands out, and that's really important because it means that there's less of a learning curve and there's just a greater comfort level with understanding everything that's going on within the company. And then the final one, Lars, the CTO, Lars Johnson. He actually has probably the coolest background out of all of these. He was previously the CTO for a very brief span at Siemens. The reason why it was brief was because his company, eMeter, that he founded and was the CTO of, was actually acquired by Siemens in 2012. And when they did the merge, he stepped in as kind of acting CTO to just mesh out those synergies and make sure that the transformation was, smooth. But Obviously, that speaks volumes of him as not only a CTO, but also just understanding technology in the role and in the industry. The fact that his company was acquired by Simons is a big plus for me because Simons is very reputable. Another really cool thing about him is he's actually been a CTO since the 80s. I believe his first LinkedIn job description as a CTO started in 1985. So that gives you, or at least it gives me a lot of confidence in his ability to, bring unique, innovative, and really time-tested innovations to STEM. And then as you look through the rest of these leadership position boards, as you look to the right over here, you can see just the other companies that are mentioned and the fact that they've combined for 150 years of experience in the software and energy space. So this is really cool. That's the other thing you have to keep in mind as well, is that because this is AI driven, it's not just energy, right? You also have to take into account the software. So it is really cool to see that relevant experience as well. All right, so let's get into more of actually what STEM is, right? So just like I said earlier on in the beginning, STEM is the first pure play smart energy storage company to go public in the US. So what exactly does that mean? Basically what they do is they will store energy. They use their AI software called Athena, and they store energy based on understanding and studying when peak times are for certain businesses in certain regions, and they will kind of collect all that data. And then what it'll allow them to do is it'll allow them to, give energy where it needs to be when it needs to be there the most. And it also will allow companies that use STEM to drastically decrease their cost because they'll be able to purchase their energy at a fixed rate when it's not as busy so that they have it at a cheaper rate. So as you can see here, they say they have a very large addressable market. We'll get into that later, but this is very incredible. 1.2 trillion in new revenue opportunities expected to be deployed by 2050, and that's kind of a ways away. But like I said, this is a long-term view you should have for this company, and they're expecting to increase their battery storage capacity by 25 times in the next decade. Another interesting thing here before we move on is 500 million in cash. A lot of that came from the SPAC transaction, and fully financed for all forecasted growth. So that also, to me at least, means that shouldn't be expecting any offerings. Okay, so this is actually how they build out their revenue model and kind of the things that they offer. They have three main ways. Sorry about that. They have their hardware and their network integration, which has the lowest margins. So this is actually the storage units themselves, and these are just mainly transactional. So you're just paying for it right off the gate for the initial purchase. Then they have what, in my opinion, are the two most important out of these three: the software and the market participation. So the software is Athena itself. This is the bread and butter. This is the foundation of what makes STEM so special. So essentially what this is the AI that drives their energy storage software that makes them so amazing. They've been talking about multiple times in interviews how this should get even more and more competitively advantaged for them because the more customers they acquire and the more data Athena is able to collect, its neural networks will be able to make it much more efficient and perform even higher than it currently does, which is honestly amazing. So looking at this is kind of just, originally I thought that this was actually like a customers list, but going back over it, I think this is actually something that is meant to show the specific industries and people who have talked about pledging to go green. So these are potential customers. Some of these are already customers, you'll see later on, but these are different institutions and government bodies that have mandated or pledged decarbonization, green movements, stuff like that. So potential customers. All right, so this is a really cool slide. I love this slide for one specific thing. They currently have more storage capacity commissioned than Tesla, which is crazy because you always hear about how many, gigafactories and all these crazy things that Tesla has going for it in terms of solar energy and storage. STEM actually has more, and they're just way further under the radar. So they currently have almost 1,000 systems operating with 1.1 gigahertz hours. That's absolutely phenomenal. And they have almost $250 million in contracted backlog. We'll get into that a little bit later as to what that means. Within 75 jurisdictions in 200 plus cities. They also have 75% behind the meter market share in California, which is the largest storage market in the U.S. That completely makes sense because, as you know, California has those blackouts and the heat waves and everything like that. So the energy storage is super important there. This is pretty cool. They call it like value streams. There's only 2 out of 13 that they don't have. And a lot of these get pretty nitty gritty. So I would just focus on the big outer ones because I think this takes a lot of time to explain. And frankly, I'm going to be completely honest with you, I don't even understand all of the technicals of each one of these. So the ISO RTO services, that's their virtual power plant and their front of the meter services. Their utility services are for utility companies, and then their customer services are more for business oriented and things like that. But the main takeaway here is that they offer basically almost all of the value streams that are available to their customers. So they really do offer that one-stop shop mentality. So this is a really cool, and this is kind of a little bit hard to understand first times you look at it. So I would definitely encourage you to take a couple minutes, pause it, and really just go into this graph a little bit. But essentially what this is showing is it just shows how they interact with the grid. So the top up here is when STEM is charging their storage from the grid, and then down below it's when they're discharging energy excess back to the grid. So the article that's associated with this is like way better to help understand. So just read this real quick. Essentially what happened was there were rolling blackouts in California, and what STEM was able to do is that they were able to offer 50 megawatts, which was enough to power 20,000 homes from batteries that they had installed throughout that municipality. So businesses, local governments, and then other customers. And then this is a very important slide as well, going through behind the meter and front of the meter because they use these terms a lot. But essentially, very quickly, behind the meter focuses on commercial and industrial. So this is reducing your energy bill, corporate ESG objectives, those kind of things. And you can use this graph here that they're discharging when prices are high and they're charging when prices are low. So you're locking in those low rates, and then you're discharging and using that energy when other people would have to be real-time spending to get it. So in order for it to fully grasp, essentially what happens with your utility bill is when you use energy, it charges you based on the time that you're using it, what the cost per kilowatt that energy is, right? So if you're using utilities at a time when it's really expensive, your utility bill is going to be higher. What STEM helps you do is it essentially optimizes your output so that it's charging when the prices are low, and then stores that low cost battery power for you so that you can discharge it when it gets expensive. And so some of their customers here, you can take a look. These are some pretty big customers. We're talking Amazon, Home Depot, UPS, Facebook, Walmart. These are incredible. They also use Whole Foods, I believe. Front of the meter is kind of the other side of the spectrum. This is for utility services, IPPSs, which I'm not entirely sure what that is, if I'm being honest, and developers. And so what this does, this is discharging when prices are high, same thing, charging when prices are low. But what it allows them to do is it allows them to time shift their solar generation and participate in ancillary revenue streams. So that essentially means that they add revenue streams, basically. And this adds 10 to 30% unlevered internal rates of return. And then this also supports grid stability because it reduces volatility and strain on the grid and also allows it to be normalized. This just talks about how they mitigate their supply chain risks. So they just choose their they basically just say they choose their suppliers really well, um, this is interesting if they're actually are being supplied by Tesla in some way. That's pretty interesting considering that's one of their bigger energy storage competitors. But yeah, that's interesting. I'll have to look into that. But essentially, they'll contract for supply 12 months ahead, and they opportunistic basically like what what normal financial departments should be doing is pre-buying equipment when it opportunistically makes sense. I mean, I feel like this slide's a little bit self-explanatory, but that Tesla tidbit is pretty interesting. Okay, so this just very quickly, the $500 million in cash available for growth with the $0 debt on balance sheet. So the fact that they're debt free, I would take this with a grain of salt because there's been some how do I say this? Essentially, there's been some issues with how SPACs have structured their deals in order to appear debt free and increase their cash available. Um, you saw it with, I believe, a couple of companies like maybe Lordstown was one of them, and a few other SPACs are being looked into. I know the SEC said a couple of things about it. So just take this with a grain of salt. I'm not saying that STEM's doing any of this or anything, but it's always good to just be aware that that's happening. Um, but at the end of the day, if they say they're debt free, I'm willing to believe them in that. And the $500 million in cash, that's a fact. That's on their balance sheet. So that is very, very impressive. All right, so now let's get into the financials very quickly. So as we mentioned before, we've got that 1.1 gigawatt hours as well as the 12-month pipeline of 1.43 billion. But I believe this is what they're expecting for the following 12 months. So the next 12 months. This is what they actually have booked right now. This is what they're expecting for 2021, and then that's what they're expecting in terms of profitability. So clearly the name of the game here is, volume will drive their profitability. They said in an interview that 2022 fiscal year is when they're expecting to be profitable. So, 12 months, 18 months away. That's not too bad, especially for as a energy storage and very futuristic type company. You would think that it would be a little bit further out. So I'm glad to see that. I was personally thinking, 2023, 2024. So 2022 seems good to me. Excuse me, sorry. And then the other note here that's interesting is the revenue seasonality. So because they're energy storage, obviously you're going to be expecting that the majority of their revenues will be coming when energy is at its highest cost, which would be in the winter months. So that's why 50 to 60% of their revenue is expected to be during the fourth quarter. All right, so now let's get into their first quarter results. This was pretty impressive. They totally kicked tail year over year. So as you can see, that 275% year over year revenue growth, which was above the high end of guidance. This was mainly driven, as they say, by front of the meter hardware sales. So if we go back just for a refresher, front of the meter is those utilities. So Ameresco, Green Skies, Summit Energy, Onyx, so and so, in hardware sales. So that's their lowest gross margin product. So hopefully, that software with the higher margins, that's going to start coming in as they, get that recurring revenue. And then their AUM more than doubled, so that's very big as well. And they also added 345 megawatt electrodes portfolio, which has not been mentioned up until this point. So that's interesting that they just kind of tucked that under the rug. And then their backlog went up 20% and 150% year over year. Again, because of those front of the meter, commercial bookings. So they're talking about 50% CAGR, 40% margins, and 35% profit margins. These are long-term targets. And so what appears to look like is 2026 expected is when they are aiming for these targets to be hit? I can definitely see revenue for sure because they're already way over revenue. So if they can keep that up, um, gross margin definitely, especially as that software starts to kick in, you're going to see more and more of that increasing. The EBITDA is a little bit shaky to me. I don't know if they'll hit 35% by 2026, but we'll see. I think I'd be more willing to accept something closer to like 20. Um, and then here's their methodology. They're basically just saying all of our stuff's going to expand. So this slide essentially is talking about what they are referring to as a public comparable universe. So they're basically just looking at their competitors and they break them down by industry niches. So you've got solar technology solutions, distributed solar, sustainable infrastructure, which I guess is like charging stations and stuff like that, and then diversified energy tech. So basically just like a catch-all for Tesla, companies that just do a bunch of different things with energy. Um, and then right down below, they kind of talk about how STEM and those specific niches correlate. So you can read through it yourselves. I'm not just going to be a lecturer for you, but the big emphasis is looking at them versus Tesla. They both will be focusing on front of the meter and back of the meter energy storage business. I think that it's super unique that they're somewhat tied up against Tesla, and that they're actually kind of outperforming Tesla, but yet they're also being supplied by Tesla. It's very interesting. I have to do a little bit more digging in that. But essentially what they're claiming on this slide is that they are kind of, hey, like we do all of this. So these are what our competitors each focus on, and we're good enough that we do all of them. And they also run on the scarcity premium. So this is something that I'll talk about in a little bit, but one of the biggest reasons why I'm in love with STEM and why I think it is the most important company / stock of the next 30 years is because it is super relevant to, in my opinion, one of the biggest and under-discussed issues in America right now, and that's our electrical grid. So if you think about all these crazy projections about EVs, other green technologies that we're bringing to surface, right? All of these are going to need power. And right now, as it is, in our current economy, our electrical grid in the US is already being tapped out. It's already under strain, it's already under stress. And looking through the infrastructure bill and hearing what they've been talking about at the White House, there doesn't really seem to me personally to be a large emphasis / push on totally reinvigorating and innovating the electrical grid. So what that means is if you can't make it better, you have to be more efficient with what you currently have. And that is what, in my opinion, STEM does better than anybody in the world. They are the best at this. And you can tell that they're the best at this because they have over 3/4 of the market share in California. They are destroying the competition when it comes to this. So let's look in some of here. They talk about the 12-month pipeline. So it's the total value of uncontracted potential hardware and software revenue currently in process. So it's essentially opportunities. They're not expecting to book a lot of that. It's reasonable likelihood. So I'd say maybe take 50, 60% off the top, and that could be a little bit better of an estimation for you. Bookings are the total value of the customer agreements they've executed. And then contracted backlog is essentially the value of those bookings in dollars. So like 12 bookings worth $300 million, for example. That's not what they have, but for example. And then these three we kind of touched on. The last one is a little bit hazy, market participation revenue. So this is revenue from monetization of energy storage capacity into energy markets and VPPs secured by contracts ranging from 3 to 20 years. Okay. So basically monetization of their storage capacity. Here is our nice little, 45-degree angle chart. Every growth company has one. I do like how they break it down based on their biggest their biggest markets. This is front of the meter markets, so this is utilities, IPPs, and other asset owners. These are typically 20-year software contracts, and the system spec size is 27 megawatt hours and $10 million per contract. And then this is the behind the meter market, the BTM market. So as you can see, very similar CAGR, but it is much more heavily concentrated in California and New York. System spec size is a lot smaller because these are individual businesses, not massive entities, and the software contracts are typically shorter. So expect a little bit more of churn and, you know, turnover with BTM as opposed to FTM. This is just looking at their transaction capital and how it's going to fuel growth internationally as well. So I believe right now they're just in Canada, but they're expecting to grow. And as no surprise to any of us, China is the biggest block here. And then this is just looking at global energy storage outlook in terms of a trend for the entire industry. So, all right, so that is it for the discussion. Now I'm just going to give you my quick opinion. Again, just a disclaimer, I do have a position in STEM, and I'm not a financial advisor. All of this has just been my opinion and expressing my own views. So, you know, there's that. But I really like STEM. And again, with companies like this, you have to, as a growth investor, because this is definitely a growth stock, it's very overvalued in terms of fundamentals. Their gross margin is negative currently, and you know they're operating in a net loss. So the 1.4 billion pro forma EV valuation is certainly high, and it's definitely trying to factor in their future growth. But when you look at companies like this, I like to invest in the idea, not the financials, as a growth investor, right? If I can wrap my mind around the company and the idea that they're presenting and the solution that they're presenting, and I think that they will get to profitability, as STEM has mentioned that they will, then that is where it really comes down to me, whether or not I believe in the company. And I wholeheartedly think that, let's just take a step back from STEM for a second. The issue with the electrical grid is going to be one of the biggest issues that we face in the next 20 years. Because if you think about the amount of electrical vehicles and other electric green initiatives that are being put into place that are going to cause so much more electricity to be drawn, the electrical grid definitely needs to be improved. But if not improved, it definitely needs to be more efficient. And right now, there's only one company in the entire U.S. That is publicly traded and that has a market-leading share of this exact issue. It's like solving this exact issue, and that's STEM. And the best thing about STEM is Athena, because Athena allows STEM to keep their competitive advantage over their competitors as they continue to grow market share and as they continue to gain customers. You know, they have over 30 Fortune 500 customers, over almost 1,000 installations and contracts and customers and such like that. So I do really believe that personally this will be a very, very important company in the next 20 to 30 years. And for that reason, I think that its stock, it'll definitely appreciate in value, especially as they turn that profitability corner. I don't have a specific price target or anything like that. That's not really the purpose of these videos. As you can see, we didn't really do in-depth analysis. I'll save that for, you know, maybe a longer segment on my channel. But for right now, I just wanted to kind of give a background and a debrief, a little quick deep dive for you guys on STEM, one of my favorite longer term plays, and kind of just give you guys a little bit background and where my mind is at on the company, and kind of get some feedback from you guys as well. So if you like what you heard, if you have any suggestions for how I should do my next video, drop them down in the comments. You can always sub and like the video, all of that YouTube stuff. I'm new to YouTube, so I don't really like saying all that stuff, but just pop back around when we make another video, and thanks for watching this. We will be doing Tesla next week, so very excited for that. But that is it for STEM. Thank you for watching, and hope to see you again soon.